Today, this is going to be part one of a three-part series on YouTube. Before I get started, I want to mention that the full lecture will be uploaded onto my Discord channel. I also want to give a big thank you to the Soup Room, Romeo, and ICT for all the knowledge that they have taught me throughout my trading journey. So this is part one of validating high timeframe key levels for low timeframe entries, an in-depth explanation. High timeframe key level validations for an entry. We look at, does it align with current market profiles and our bias/anticipation for price? What and where are our discount premium levels within our dealing range? How is price reacting to the key level? Is it expanding through, disrespecting it, or is it forming a reversal pattern? And finally, is SMT present on the low time frame while testing the higher time frame key level? Higher time frame bias and how to identify it. Why is higher time frame bias important? Well, understanding higher time frame directional bias is crucial for a consistent and successful total soup trader. Many traders focus on concepts like market structure shift, breaker block, order blocks, and optimal trade entries, but they often overlook higher time frame bias, which is a key element of trade selection and risk management. Key elements to identify high time frame bias. When determining a high time frame bias, focus on highs and lows. Are they being rejected or taken out? FVGs or fair value gaps. Are they being respected or filled? And our opens and closes. Are we opening above/below key levels? To accurately assess higher time frame bias, ask yourself, what is a safe low or high to use as a stop loss? What is a conservative target? Which opening price, like PD arrays like breakers, are we respecting/disrespecting? What are the odds that a gap does not get filled? And are down close candles acting as support, or are up close candles acting as resistance? Side note, a high quality FVG is one that aligns with lower time frame equal highs/lows. Very important. Note that down. So let's take a look at this slide. We have these equal lows resting here. We have this bullish fair value gap resting beneath it. Why don't we take this fair value gap here? Well, simply because it has already been filled. Okay, there is no longer a buy side imbalance here. Price has already rebalanced this inefficiency. Now, price has tested this FVG here that we've marked out. However, it has not filled the fair value gap. So we can take it and wait for price to sweep these lows to then tap into this fair value gap and reverse. So what happens? Price takes the equal lows marked by this line, fills the FVG, respecting it, and reverses to the upside and continues to break structure. This is an example of a high quality fair value gap. Some traders may take this market structure shift as a bullish indication that price is going to continue higher. However, that is not the case. Yes, market structure works most of the time, but not always. And it is nothing without high time frame context. We see this lower time frame market structure shift, yes. But what happens on the higher time frame? Well, we are clearly in a bearish trend. We are respecting highs, respecting highs, respecting highs, respecting highs, and we are breaking lows. We break this low, we break this low, this low, this low, this low, this low. This market structure means nothing. This was the market structure that we had marked out. Okay, you can see how it closed above but eventually it broke down even further. And mind you, looking at this on the higher time frame, I would not count this as a microstructure shift. Sure, you can say this is the high that broke the low, though I would much preferably take this obvious high, as it is the first high formed before breaking the previous low here. Identifying trends versus consolidation. A bearish bias equals rejecting highs and breaking lows, as we mentioned right here. Breaking lows, rejecting highs. A bullish bias is rejecting lows and breaking highs. And a consolidation is price respecting highs and lows, showing no clear breakout direction. In a consolidation, we wait for a gap or a fair value gap to form before anticipating a breakout. The false breakout on one side, let's say the buy side, increases the probability of a true breakout in the opposite direction, so the sell side. What about higher time frame influence on lower time frames? A given time frame remains bullish only until it reaches a higher time frame key level. A given time frame remains bearish only until it reaches a high time frame key level. What does this mean in practice? Well, a 5-minute gap will only be respected until price reaches a 15-minute key level. A 15-minute order block / up close candle will only hold until price reaches a 1-hour key level. A 1-hour high / low will only hold until price reaches a 4-hour key level, and a 4-hour key level can be invalidated if a monthly key level is in play. Note, it doesn't have to be an order block, it can also be a 5-minute FEG, will hold until price reaches a 1-hour key level. Here is an example of a 15-minute order block / up close candle will only hold until price reaches a 1-hour key level. Notice we have this up close candle on the 15-minute, respected. This up close candle, respected. This up close candle, respected. Respected, 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 until we get to this 1-hour fair value gap, which is a 1-hour key level. So once we come to retest this 15-minute up close candle, we end up expanding higher. A 1-hour high / low will only hold until price reaches a 4-hour key level. This 1-hour low is being respected. This 1-hour low being respected. Notice this is a bullish trend. High, disrespected, high, disrespected, high, disrespected, right? We have our what some might call a market structure shift. However, we do end up breaking this high, digging deeper into the 4-hour order block and 4-hour inverse fair value gap before eventually showing a true market structure shift by closing below this low. This is not a market structure shift simply because this low did not break a high. This was simply a low that formed after this high. It did not. So a market structure shift would be closure below a low that broke a high. So the closure below this low here, this low broke this high. As you can see, we formed a low and then we broke the high, and then we closed below this low. This is the true market structure shift. So once we reach this 4-hour key level, we begin to disrespect all of these lows and all of these bullish PD arrays. Dealing ranges. How to identify a dealing range. A dealing range is defined by the high and low that price established during a trading session or specific time frame. It presents the boundaries where price action will fluctuate before eventually breaking out. Discount levels are favorable for long positions, in brackets buying opportunities. Premium levels are favorable for short positions or selling opportunities. And note this down, for a true dealing range to exist, both sides of liquidity, highs, and lows must be taken. Notice in this image, we have this buy side liquidity and we have the sell side liquidity, the high and the low. This low sweeps the low, then we look for a sweep on the buy side to form a true dealing range. And we do that. We form our dealing range from swing low to swing high after taking both sides of liquidity, and we have our dealing range. We have our discount in the bottom and our premium at the top. Premium versus discount for PD arrays. Respecting premium bearish PD arrays, avoid buying at premium levels. If we're respecting discount bullish PD arrays, avoid selling at discount levels. The golden rule: do not buy a bullish fair value gap unless it is in discount, and do not sell a bearish fair value gap unless it is in premium. On this chart, we notice we have our dealing range. We have this 4-hour order block right here. Notice how it is in deep discount, and every time we come to it, we respect it. Respect it once, respect it twice. Okay. We have this 4-hour key level as well, this 4-hour order block, which is at EQ, mostly in the discount. We close above, respect, right? We respect again. We never close below the order block. We respect, respect, respect. Notice this premium bearish fair value gap. We tap it, we respect it, we dig a little bit higher with this high, and then we respect it, and eventually we fill it and go higher. So this should give you a good idea of how price should react in a premium and how price should react in a discount. Thank you everyone for tuning in. Again, if you want to get access to my full lecture early, I will be releasing the full lecture before all 3 parts get uploaded on YouTube tomorrow on my Discord server. Feel free to access that through my Linktree link in my bio. For now, take care, good trading, and good luck.